Good day, and welcome to the 90s. Things look a bit different in this decade, and that's mostly what we're going to talk about today. In a moment, we'll turn our attention to the future and what each of us must do to prepare for the years ahead. But before we do that, let's look at where we are today and at the specific factors that make this time important to all of us. First, it's not news that change is everywhere. Social conventions and needs are changing as fast as new technologies. In case you'd forgotten, over the past 10 years, we said goodbye to vinyl records, wind-up watches, typewriters, and many of our primary industries. We said hello to CDs, digital electronics, personal computers, robotics, Walkmen, and global environmental responsibility. As a result, the pace of everyday life has just gone faster and faster. And I don't have to tell you that it's bewildering. When things are changing so fast, it's hard to tell the difference between a legitimate trend and a passing phase, and in such circumstances, sometimes it's difficult to think as straight as we should. Today, I want to talk to you about thinking straight when it comes to planning for the years ahead. It's absolutely critical that we as individuals look forward together, because there are some very important things happening. Things that will affect all of us down the road. First, there's the matter of aging. Our nation's population is proportioned in such a way that a majority of us will be moving past middle age during the 90s. The bottom line is that many of us will be approaching our retirement years as a large group, a fact that will severely tax and deplete government resources. To complicate the situation, there'll be a smaller active workforce to pay the taxes to support these services. And of course, there's always the nagging uncertainty of Social Security. Then there's inflation. It's called the hidden tax. Let me show you how it works. Let's imagine that this water is your savings. It doesn't matter whether it came from investment or monthly savings or a family inheritance. It represents what you've set aside. When we fill the bucket, it's 100% full of your savings. But there's a nasty process at work here you can't yet see. It's the ongoing and inevitable effect of inflation, the undeniable fact that items will almost certainly, eventually, cost more tomorrow than they did today. This means that the buying power of these savings is constantly getting smaller, like this. Over the past 10 years, inflation has run at a rate of about 4% per year. That means just to keep the bucket full, you have to keep putting in more at the top in order to keep your buying power at full force. At the same time our buying power is gradually eroding, expenses for the very things we'll need as we age have been increasing at a rate greater than inflation. Look at the costs for housing, education, and health care. As you can see, we're all being squeezed from both ends. We have less to spend for things that are costing more and more. Most significantly, statistics show quite clearly that as a group, we're all doing a pretty poor job of preparing for those future years through savings and investing, especially when compared to the people of other countries. As you can see, we trail people in most other industrialized nations. That's the bad news that tells us in cold, hard facts we've all got work to do, work we cannot ignore. The good news is there's still hope, but only if we each make a very direct and personal commitment to do something positive. Because when you take away all the fancy words and economic jargon, the simple truth is that each and every one of us is totally and personally responsible for planning for and paying for our later years. Unless you're in line for a major inheritance, or absolutely certain you can win the lottery, only one person is going to stand up to pay for you down the line, and that's you. That brings us to what investment is all about. It's taking small amounts of money today and investing them in ways that try to assure they grow faster than the rate of inflation. Your organization understands this, or else you wouldn't be watching me today. Somewhere along the way, it decided that planning for the future of its members was important enough to create a plan, some sort of retirement savings and investment program. The shape and details of this plan or program varies from group to group, but They all share in the goal of helping people prepare for their future, hopefully through investment programs that are as safe and responsible as possible. As part of your group's program, they've decided to hire professional investment managers, people who spend their entire professional lives studying markets and investments. One such person is James Crabb, co-founder of the Crabb-Hewson Group, one of the Northwest's leading investment firms.
Hello, I'm Jim Crabb, and I'm proud to say that our firm, the Crabb-Hewson Group, has been selected as the investment manager for your organization. Today I'd like to explain what we do, as well as some of the basics of investing in the 90s. We'll keep it as simple and uncomplicated as we can, but please make an effort to stick with us, because I assure you that this is one of the most important talks you'll ever hear. We're going to give it to you straight. Someone once said, "From small seeds, great oaks grow." That saying describes very simply how investing works. The driving force behind investing is a magic process called compounding. Let's plant a seed together, water it with compounding, and see what happens. Compounding occurs when you make a beginning investment with the intention of earning a certain rate of interest. As you earn the interest, you have it added to the initial investment so that now future interest is paid on the combined value of the initial investment and the interest it earned. As future interest payments are made, they're left in the account, compounding, so that the investment grows and grows at an ever-increasing rate. Now the trick is to decide exactly where to put our seeds. Let's look at some examples. Imagine you planted a seed equivalent to $100 15 years ago in 3 different pots. If you planted the seed in a passbook savings account at a bank and it grew at a compounded interest rate of 4%, after 15 years your investment would have grown to $180. If you had planted the same seed in a 5-year government bond with compounding, your investment would have grown to $317. The same seed planted in $100 worth of Coca-Cola common stock would have returned $1,217 after 15 years. Here's a chart that shows the actual returns on several different investment types between 1973 and the first quarter of 1991. It also shows their worst and best year performances. It's very important to notice that all of these investment types have had their considerable ups and downs, but that on the whole, they've all delivered average actual returns far greater than the nation's average of 4% inflation. This chart demonstrates why people employ investments like stocks, bonds, and treasury bills. Now, it used to be that to design an investment program, managers would carefully select each and every stock or bond they'd use to meet individual investors' personal investment goals and risk orientation. But during the 70s and 80s, an important new set of investment tools came into favor. These tools provided new investment options and instruments that pooled together investors' money, thus reducing risk and greatly simplifying the investment task. Now, instead of designing 30 different investment programs for 30 different investors, financial professionals could manage one large investment program that met the goals of 30 or 30 million investors.
One such product is the mutual fund. It's become so popular, 30 million American households use them as their investment vehicle of choice. Each shareholder in these pooled fund programs owns a proportionate share of all the stocks, bonds, and securities held by the fund. As with all pooled investment programs, experienced portfolio managers study and choose which investments are best for the fund. Financial analysts collect vital information on hundreds of companies and the industries in which they operate. They also evaluate and keep track of the securities issued by federal, state, and local governments. This knowledge is used by the investment management firm to invest shareholders' money in a diversified group of investments with reduced risk. Building on our earlier plant example, a pooled investment fund is like having a whole greenhouse of potted investments, all different, but under the same roof. The money managers and investment team tend the greenhouse on your behalf, seeking to create investment combinations that fit your particular investment goals. We find that individuals operating on their own who want to seek out the best investment in specific industries can often have a very rough time going it alone. How much time do you personally want to spend finding out if the earning expectation on a specific stock is performing to standard this quarter? An investment firm dedicated to pooled investments has the staff to do it for you. Pooled investment programs also are flexible enough to take into account different personal goals and times of life. It shouldn't be a surprise to you that younger people most likely are saving and investing for things like new homes, cars, and college education for their kids. At the other extreme, older people who either have retired or who are preparing to retire seek to assure that their savings and investment income will provide monthly checks to pay for food, housing, health care, and a little travel. Happily, the pooled investment greenhouse permits us to easily create programs to meet the objectives and needs of all group members, from the middle to both extremes. Let me show you what I mean by introducing you to some of the tools we use in the pooled investment environment. Before I do that, I'd like to take a very brief moment to explain that nearly all investment firms practice a specific investment style. To discuss ours, permit me to introduce Dick Hewson, the other founder of the Crabb-Hewson Group and a leading investment strategist.
The Crabb-Hewson Group employs a contrarian investment philosophy. In its simplest form, a contrarian is one who believes you sell an investment when most people are buying, and you buy when the majority are selling. Most investors see an asset that is going up in price as becoming more attractive. This is true regardless of what this asset may be: antiques, real estate, as well as stocks and bonds. Conversely, most investors view an asset that is depreciating in price as becoming less attractive. This all seems quite logical to most investors, and while this may work very well for some, a contrarian investor takes the opposite view. To us, an investment that is rising in price is becoming less attractive. That does not mean we rush to sell it, but we must take the mindset that at some point it needs to be sold. On the other hand, an investment that is depreciating in price or is already low often becomes increasingly more attractive to a contrarian investor. This does not mean we buy solely because of the low price. Fundamental factors such as the company's financial strength and outlook, of course, come into play. But we must take the mindset that the investment is becoming more attractive by virtue of the discounted price. Anything of value that has gone down eventually should move upward. Emotions always play a large part in the investment world, but contrarians try to move emotional factors aside and key their decisions on facts. We at Crabb-Hewson work hard to identify and buy well-established, sound companies. Over a period of years, we expect the fundamental aspects of the companies we invest in to improve, including sales, earnings, dividends, and net worth. Now, fundamentals do not rise constantly. They nearly always have setbacks along the way. These setbacks can be moderate or occasionally sharp. But again, we protect our position by investing only in companies that are long-standing, proven performers. Stocks and companies that have been around a long time and proven themselves through good times and bad. There's both art and science in this approach, but over time, it's proven a safe and smart way to grow our clients' investment dollars, usually at a rate well ahead of inflation.
Now let's take that tour of some of our pooled investments I promised, so you can see how we apply the tools we have in designing a portfolio that matches our customers' investment goals. We've arrayed a basic group of investment tools so you can see how easy it is to design a program for nearly any investor, depending on that investor's financial goals and willingness to assume risk. We've lined these tools up on a scale that shows you the relationship of risk to return. Generally, you can assume the tools shown at the left end of the scale are the least risky investments. As a rule of thumb, the lower the risk to the investor, the lower the likely return. As we move along the scale toward the right, the risk gradually increases, but the returns also get proportionately larger if the investment is successful. Of course, the inverse is also true. That is, the potential for losses looms larger as the risk increases. Let's take a closer look. At the far left, we have the traditional money market account. This investment has very little risk associated with it, as its returns are tied to short-term interest rates. Because of this, it tends to deliver modest returns. Firms like ours frequently use this tool as a place to park funds when other more volatile investments are going through cycles of turbulence. However, the money market funds have trouble keeping up with inflation over the long haul, so we are obligated to use other vehicles if we are to meet our clients' usual goals of beating inflation and retaining and increasing buying power. In the mid-range of our risk scale, we find tools like bond funds and what are called balanced funds. These deliver returns that are historically higher than the money market funds, but each is subject to price fluctuations tied to investor confidence or consumer expectations. So basically, while these investments have historically performed better than the lower risk investments, they have their emotional ups and downs, and together we have to take that into account in our investment planning. Graduating to the riskier end of the scale, we find funds that pool investments in stocks of varying types. Now this is where the word volatility is used a lot. That means that the prices of these stocks go up and down frequently, reacting usually either to news involving the economy or the specific company or industry sector involved. Any chart that shows the history of the stock market shows that ups and downs are its way of life. But over time, few investment options have proven as efficient in beating inflation and retaining earning power. At the far right end of our risk spectrum are growth funds, which specialize in the stocks of small, fast-growing companies whose track records are short and expectations high. These funds generally experience the widest swings in value and are usually reserved for the most speculative of investors. These, then, are some of the basic tools investment managers use, and by mixing and matching them, we can tailor a personal or group investment program to meet nearly any goal you may have. For instance, if we were directed to take a sum of money for a family in their 30s planning to retire in 35 years, we'd probably recommend a program like the one on the left. On the other hand, if we were directing the same amount of money for a couple in their early 60s planning to retire in 3 to 5 years, we'd likely suggest a program like the one on the right. So you see, whether we're investing for individual families or whole groups, we have the flexibility to custom tailor the program that fits the investor's personal goals. Now, to simplify things for their members, many organizations choose instead to select a solid mix of pooled investments on behalf of their membership. In such instances, the Crabb-Hewson Group is asked to work with trustees of the organization's retirement plan and to choose pooled investments that will retain buying power and stay ahead of inflation, all with minimum risk. This is a common approach for Taft-Hartley or Union retirement funds. We follow their directives, applying our professional know-how on their behalf, and report regularly on our progress. This is a very efficient approach when you have a large number of plan participants. Recapping, the world is changing fast, and one of the most important changes for Americans to understand is that we are each personally responsible for planning our financial futures. If you are one of the fortunate few who is in an organization-sponsored retirement program, bravo for you. You're ahead of the game. You may wish to consider supplementing what you and your organization are doing by dedicating more of your monthly income to investing for the future. This is strictly a personal decision, tied to your dreams for the future and your ability to set more aside monthly. Well, that's an overview of investing in the 90s and the role that the Crabb-Hewson Group plays in partnership with you and your organization. Remember, if you need help, you have 2 able partners to turn to: your organization and the dedicated staff managing your plan, and the Crabb-Hewson Group, where we're always ready to lend a hand or answer your questions. Thanks for spending this time with us, and best of luck throughout the 90s and beyond.